The non-farm payrolls report beat market expectations with a read of 255,000 jobs created in July against a forecast of 180,000. Now, the data revived Fed hawks and brings the chances of rate hikes by the end of 2016 back on the table. On the back of the NFP read, the US dollar has picked up some momentum on the upside. A major question now is, could the Fed hike rates, given that the rest of the world is playing on the loose side of the game? Now let's see what other central banks are up to. As widely expected in the UK, the Bank of England cut the bank rate by 25 basis points, but surprised investors by expanding its sovereign bond purchases target by £60 billion and by announcing a brand new corporate bond purchases programme worth £10 billion. Now, the sell-off in the pound has been reasonable, perhaps because part of the announcement was already broadly and exaggeratedly priced in. As a consequence, the market was sufficiently short pound heading into Super Thursday. Although we didn't see cables sliding below the 130 mark against the US dollar last week, LCG senior analyst Ipek Ozkardeskaya believes the bias remains comfortably on the downside, with a chance of a reasonable upside correction following a somewhat sharp sell-off following the Bank of England meeting. Now, on an hourly chart, we could set the short-term resistance to 132.10, which is the major 38.2% retracement on the post-BOE meeting sell-off. Now, only surpassing this level would bring back the possibility of a short-term bullish reversal. Below 132.10, we keep our bearish bias even in the short run. Our medium-term view is unchanged. Now, the pound-dollar is considered in a negative trend below 136.40, with the possibility of a further depreciation towards the 128 to 125 area against the US dollar. On the agenda next week, the Reserve Bank of New Zealand is expected to lower its cash rate by 25 basis points to 2%. Now, with lower interest rates, the appetite for carry traders is set to fade. Cash is expected to move into emerging market currencies and corporate and sovereign bonds. Now, in Asia, China's inflation figures and retail sales will be in focus. Again, LCG's Ipek Ozkardeskaya says that such economic data in China should be treated with extra care, given that capital controls and liquidity restrictions in China are likely causing a significant divergence with the reality. Now, the slowdown in China's growth has been a leading macro story over the last year. Softer Chinese inflation and a slower than expected growth in retail sales volumes could trigger a new sell-off in the Aussie, but also in oil and commodities. Finally, US crude traded below $40 earlier last week, yet managed to recover above this level as analysts insisted that the bear market would not last due to lower production globally. But a sustainable recovery in the oil market is still not a done deal. A failure to hold the ground above the $40 level could revive fears of a fresh sell-off. Breaking $39.25 will certainly bring the possibility of a further fall to $37, then to $35. That's all for a look at next week's economic calendar, but join us next week for a look at the financial markets again. Goodbye for now.